While most people are watching the news and they're panicking about what's happening in this market, the smartest investors I know are doing something completely different. They're buying. And right now, I'm personally working on some of the best value deals I've seen in years in Dubai. Now in this video, I'm going to explain exactly what a distressed deal is, what's actually available in the market today, what developers are doing to compete with these deals and buyers, and how you can tell the difference between a real opportunity and a trap. Let's start with context because it really does matter. Dubai's market in early 2026 has gone through a genuine shock. The Iran conflict sent the DFM real estate index down roughly 21% in under 2 weeks. Transaction volumes in the first half of March have dropped 37% year on year, and the buyer sentiment has stalled. Site visits were cancelled and people asked to wait for clarity. That is the fear side of this story. Now here's the other side of the story. Physical property prices in Dubai have not fallen 21%. Median apartment prices as of mid-March were down approximately 3% from last year. Villa prices are still up 16% from last year. The stock market repriced developer equities fast, and because equities move at the speed of the sentiment, bricks and mortar will move slower. What happens first in physical property is not price drops, it's negotiation. It's motivated sellers, it's developers offering incentives to maintain sales velocity. And that gap between sentiment and physical reality is exactly where opportunity lives. So, what is a distressed deal? And I want to be very precise here because this term, it gets thrown around a lot loosely. A distressed deal is when a seller needs to exit fast, faster than the market price allows, and they are willing to accept below market value to make that happen. The distress is theirs and the opportunity is yours. There are two types right now, and really, in my opinion, every single buyer in the market does need to know the difference. The first is what I call bad distressed. This is a weak project in a poor location with low liquidity. It's been offloaded because it was never good investment in the first place. Someone bought it because the payment plan was easy, but the area is oversupplied. Now, think about JVC and Arjan. Now, I covered these last week. You can go back and watch those videos. And now those people cannot exit at a profit, so they're calling it distressed deals. It isn't. It's just a weak asset that's getting cheaper. In my opinion, you need to avoid it. The second is a proper distressed deal. It's a quality asset in a very strong location with genuine long-term fundamentals, and it's being sold below the market price because the seller has real financial pressure. Multiple payment plans potentially running simultaneously. There's a cash flow gap, the panic driven by news. These are the moments you only see in uncertain markets like what we're seeing right now. Currently, we are in one of those moments. Now, according to analysts on the ground, right now, you can buy better than you could 6 months ago. That is a fact. And the best deals in proper distress, they are extremely limited. They either have never reached the open market or they're gone within 1 or 2 days. And that is the reality of a proper distressed deal. Now, I want to be fully transparent about what I'm personally working with right now because I think it's a lot more useful than just general off-plan or general distressed deals, right? I'm currently working with sellers who actually need to exit fast. Some of these deals, they're sitting at 5% below the current market value. That might not sound too dramatic, but on a 2 million dirham property, that's 100,000 dirhams saved before you've even negotiated with the seller. And I have actually one deal right now. It is a direct resale with Imar in one of the best upcoming villa communities in Dubai. And this unit is priced over 10% below the original price purchase with Imar. This is 10% below Imar pricing in a premium community. That type of entry point doesn't exist in a normal market. It exists because someone brought during peak enthusiasm and they have multiple commitments and they need to move the property. Now, me personally, I'm not going to name these projects on camera because these deals, they move very fast and I definitely don't want to create noise behind it. The owner has actually asked me not to. But if you are serious about this, the form is in the description. Fill it out. I'll come back to you directly and I'll share that deal with you. But the point is, these real deals, they do exist and they are real. But you need to be ready to move. The window is very short when you find a good distressed deal. Now, let's talk about something that, in my opinion, doesn't get enough attention. And this is what are developers doing right now to compete for buyers in a market like this? Because even beyond the secondary market distress, the primary market, off-plan market, has shifted significantly. But the developers, in my opinion, they're not panicking. They're adapting. And the incentives that are being offered right now are some of the best incentives we have seen in years. Now, I'd like to walk you through some specific examples that are live in the market right now. Handover, for example. On certain products and certain projects, they are now offering a 40-60 payment plan. In a normal market, you'd be paying 60% during construction and 40% at handover. That has flipped. Right now, it's 40% during construction and 60% on handover. That dramatically reduces your upfront capital commitment. Now, Handover, they're also covering the 4% DLD fee on selected products, which means essentially you get 4% refund. On a 2 million dirham property, that's 80 million dirhams the developer is paying for you. Another developer, Ellington have came out with something crazy recently. They are offering guaranteed 7% return on investment for 5 years on certain developments. Now, let me be clear about what this actually means. They are contractually committing to pay you 7% annual yield in writing for 5 years. That is a developer taking on the rental risk so you don't have to. It's an extraordinary offer and it tells you that they are very serious about maintaining buyer confidence. Another one which we've seen come up recently is one by Damac. Damac are offering a 4% DLD fee coverage and a payment plan of 50-50 on selected products, which means that you pay half during construction and half on handover. Again, that is reducing your cash outlay during the build period. Now, here is a piece of this that almost nobody explains clearly, and it completely changes the investment calculation on every single one of these developers' deals. At handover, whatever the balance remains on your payment plan, it can be mortgaged. The bank steps in, and at the point you receive your keys, you can finance the outstanding amount. So what I wanted to do was I'd love to apply that to actual deals and I'll walk you through it. Okay, so when we look at Handover's 40-60 payment plan, you pay 40% during construction and the 60% remains on handover. That 60% can be mortgaged. You don't need to bring that cash yourself. Again, for Damac, 50-50 payment plan. You pay 50% during construction and 50% on handover. That 50% can be mortgaged on handovers. And here's why it matters when we actually look at the real numbers. Okay, so let's take a 2 million dirham apartment on Handover's 40-60 payment plan. You pay 800,000 dirham during construction, and at the time of handover, the bank will mortgage the 1.2 million dirham balance. The rental income on that apartment, the current yields are around about 6% in Dubai, which is approximately 10,000 dirham per month. Your mortgage repayment on 1.2 million dirham is approximately 7 to 7,500 dirham per month. So essentially the tenant is paying the mortgage and you are cash flow positive from day one. Now, I'd also like to scale it to a villa or a townhouse buyer. Let's take a 6 million dirham villa on a 40-60 payment plan structure. You pay 2.4 million dirham during construction. The 3.6 million gets mortgaged at handover. Rental on a premium villa sits at around about 5% yield. It's 25,000 dirham per month. Mortgage on a 3.6 million dirham over 25 years is approximately 21 to 22,000 dirham per month. Again, the tenant services the debt, pays your mortgage for you. The developer incentive gets you to hand over at a lower cash cost, okay? And the mortgage is what lets your capital keep working in the background. The tenant pays down someone else's debt while your asset appreciates. Now, that is the full structure, and very few people explain it properly, right? Now, I want to put the DLD waivers in context because, in my opinion, it's very, very important to look at this. The DLD waiver, whether it's Handover, whether it's the MAC, or anyone else, is always worth 4% of the property price. So on a 2 million dirham unit, it's 80,000 dirhams back in your pocket. That is real money. Now, Ellington's guaranteed yield offer is the most unusual of all of these. It's not typical. It's the first we've ever seen a developer do. It's a developer essentially underwriting your investment return for 5 years. Obviously, we'll have to read through it carefully and make sure that Ellington are actually honoring what they said, but I have already, and the headline is compelling. It is very true. The honest caveat here is developers, they don't offer these things when demand is strong because they don't need to. The fact that they are offering them now tells you something about where the sentiment sits. But it also means that the entry conditions for buyers are better than they've been for several years before. Now, how do you tell a genuine opportunity from a trap? Okay, because not everything being marketed is a distressed deal or a developer incentive. It's not always worth your money. So here are the questions I ask on every single deal before me or my investor would go ahead and purchase. The first question, is the location fundamentally strong? Not just today, but we look at 3 to 5 years ahead. Is infrastructure coming? Is there an employment base? Is the population growth? Because if you strip away the discount, would you still want to own this asset? That's number one. The second, who is the developer? Tier 1 developers, Imar, Handover, Ellington, the MAC, they have track records. They've completed projects, regulated escrow accounts. You can verify their delivery history on the DLD portal. If we look at Tier 3 developers offering huge discounts on an off-plan, but it's in a weak location, it's a completely different conversation entirely. The third, why is the seller exiting? If it's a genuine financial pressure on a quality asset, that is a proper distressed deal. If it's a developer just clearing inventory that never sold well anyway, in my opinion, that's a red flag wearing a green tie. You have to be careful of those. The fourth, what does the supply pipeline look like at handover? We've shown you what happens when 12,000 units land in JVC in 1 year, previous video. Before you buy any off-plan deal, you need to ask how many similar units are being delivered in this postcode in the same 12-month window of my unit, because that's what you're going to compete against at handover. If all of 4 questions are yes, you have a great proper opportunity. If any of them are no, maybe we need to keep looking and try and find something else. Here is the final thing that I want to leave with you before this video ends. Every major cycle in Dubai property has created a buying window for those who moved while others waited. COVID, March 2020, the people who brought in Q2 2020, when the sentiment was at its worst, went on to see over 200% gains by 2024. The 2008 market crash, the investors who bought in Dubai, Marina, downtown in 2010 and 2011, at depressed prices, built the most significant property portfolios this city has seen. I'm not saying the current situation is 2008 or COVID. The fundamentals today are structurally different and they are a lot stronger. Physical prices have barely moved. This is a sentiment correction. This is not a structural collapse. But what I am saying is these windows do not stay open. The moment certainty returns, whether that is a ceasefire, a stabilization of oil prices, or simply time passing, motivated sellers stop accepting discounts. The developers, they pull their incentives. The deals available today, they will not be available in 6 months' time. The question is whether you're the person who acts while others wait, or do you wait while others act? If you are looking at the current market and you want to understand what's exactly available right now, whether it's a distressed resale or a developer incentive deal or a specific project that I think makes sense, fill out the form in the description below. I'll come back to you directly and let's have a chat. Now, if you do have any questions, feel free to pop them in the comments. I will come back to you on the comments, just try and help you out. And if this was useful, please like the video and subscribe to the channel. It genuinely does help me keep making content like this. And as always, I'll see you on the next one.